want to make us start then, everyone. So welcome to our annual review with the Bank of England, a long-standing event now for us as a firm, and always proves to be a particularly popular one in the calendar. So we're delighted again to be joined by Paul Mount from Bank of England, one of the regional deputy agents. Historically, we used to put this event on face-to-face. Obviously back in 2020 with the onset of the pandemic, we were forced to move online. We did have a bit of a debate earlier on this year whether we should perhaps move back to that format, but we've got a good number of attendees this morning, so I think it proves that it was probably the right decision to stay in this format. And I think with petrol prices nearing sort of £2 a litre now, I'm sure everyone's probably grateful to avoid what might otherwise been perhaps unnecessary journey. And I'm sure that point around rising energy prices will be a hot topic as part of Paul's review coming up shortly. Now, we always enjoy a very sort of lively Q&A session as part of this event. I'm sure today will be no different. So at the bottom of your screens, hopefully you will see the Q&A function. So please do use that anytime during the presentation to post your questions, which we'll be putting to Paul a little bit later on this morning. Just as a help to me, please pop those Q&As, the questions in that Q&A function as opposed to the chat box. Just helps me to pick them out and make sure that we get as many put through to Paul and get his responses in due course. So without further ado, I'd like to hand over to Paul, allow him to start his presentation, and we'll look forward to picking up with you all shortly in the Q&A session. So over to you, Paul.
That's great. Thanks for the introduction, Pete, and hello everybody, and thanks for joining today. So I'll say a few words first about the Bank of England and about me. So I'm sure most of you will know, but the Bank of England is government owned, but we operate independently. And we've operated independently since 1997. And since then, we've had agencies in all the English regions and in Scotland, Northern Ireland and Wales. And the agencies really have two roles. One is we talk to businesses and public sector leaders and third sector organisations in our regions about what's really happening in the economy, and we build up a picture of that across the entire country, and that feeds in to policy making decisions at the bank. So the bank's responsible for monetary and financial stability, and most of the information we gather tends to feed into the monetary policy side, so the Monetary Policy Committee who sets interest rates. The other part of our job is doing this. It's explaining what the Bank of England is doing and why, and also updating people on the economic outlook, because when we set interest rates, we always have sort of forecasts of how we think the economy will develop, and that's going to be what I'm going to talk to you about today. So if you could move us on one, please, Robert. So the forecast that I'm going to talk you through was done in May. So the bank publishes forecasts quarterly. We have a 3-year forecast horizon. So when we set interest rates to hit the inflation target, which is consumer price inflation at 2%, we try and look through the sort of underlying data to get a sense of where we think the economy is going. So I'm going to talk to you about a forecast that's looking out for 3 years. So interesting time for the Bank of England. You know, we have an inflation target of 2%, but we actually, have currently April's inflation number was 9%. So we are in a difficult period, and unfortunately, that 9% isn't driven by outstanding economic growth. It's very much driven by a number of supply side shocks. So the first one, of course, is the war in Ukraine, and that's led to further sharp rises in commodity prices and more pressure on supply chains. And we think that by the end of this year, inflation will actually be above 10%, which will put a squeeze on household incomes and profits. What we've also got at the moment is a very tight labour market, as I'm sure you'll all be seeing out there in the real world. There is a sense that businesses want to rebuild margins, so there is upward pressure. There is upward pressure on prices. A lot of businesses do tell us that they're reasonably confident that they can raise prices in the current environment, although as I'll say later, that's starting to change, and I would say in sort of consumer goods and consumer services companies, so those consumer focused businesses are becoming a little bit more wary, I think. So I'm going to talk to you about the forecast. It's very much a sort of forecast in two halves: inflation high now and staying high into early 2023. But as 2023 progresses, we think that energy and tradable goods prices will start to stabilise, and that inflation will fall back. And also, as consumers, as households have to rein in spending because food prices, energy prices, those sort of staple things that people need to buy are going up, they'll have less money to spend on other areas, and ultimately spare capacity will open up, and we'd expect less sort of inflationary pressure. So this forecast suggests that inflation will be back to target within 2 years, and then maybe even within 3 years, maybe below it. But as I'll talk to you as we go through the forecast, there's an unusually high amount of uncertainty around some of the key assumptions about things like energy and commodity prices. So if you could move us on a slide, please, Robert. Okay, so this is the inflation forecast. The chart on the sort of right-hand side in the shaded area, if you look at the dark orange shaded region, and effectively if you drew a line through the centre of that, you'd have our sort of central case for inflation going out to 2025. The lighter shaded regions is a sort of probability distribution, reflects some of the uncertainty. But focusing on that sort of central case, as I said before, we don't think inflation has peaked yet. We think it will go as high as 10% in the fourth quarter of this year, and it's very much driven by energy and goods prices, and I'll say a bit more about that in the next slide, but also underpinned by a very tight labour market. And as I said in the introduction, that the main driver of inflation coming down during this forecast is actually weaker consumption as household incomes get squeezed, and to some extent as well, weaker investment as firms start to react to the uncertainty in the economy, and we think probably quite low demand, and start to possibly rein back investment. We're also assuming that those energy and commodity prices stabilise. Now, there's a key assumption that I always stress in this forecast, which actually this already has an increase in interest rates baked in. So the Bank of England forecasts are always based on market expectations of interest rates. And back in May, the market was expecting the base rate to be at 1.5% by the end of 2022, and then to peak at 2.5% by mid-2023. So that's already in the forecast. I always stress that because it's important, I think, to realise that. If you could move us on one more, please, Robert. So I've included this chart because it really just shows the extent to which external shocks have impacted inflation really over the last sort of 6 to 9 months. And if you see the sort of the turquoise bar and then the sort of purple bars, they're showing the extent to which imported goods and energy prices, increases in those, have impacted on UK CPI. So they've had an enormous impact really since, I suppose, the start of 2022, back end of 2021. And there's really very little, to some extent, that the Bank of England do directly about those because they're imported. And it is very much seen as a sort of a terms of trade shock. What I would say though is if you look at the services bar, so that sort of bottom green bar, that actually services inflation is increasing. That is very much domestically generated, and that is something that the Monetary Policy Committee at the bank looks at very closely, because that services domestically driven inflation tends to be more persistent, and that's partly because it tends to be driven by wage inflation. So if you could move us on another one, please, Robert. So I said a little bit about the sort of importance of energy. So here, just thinking particularly about gas prices, and you can see from the curves on the sort of right of the chart, you've got the orange curve, which is the futures curve for gas prices as of May 2022, and then you've got the purple curve, which was what we were looking at back in February 2022. And I suppose to some extent it shows a number of things. One, it shows that markets expect gas prices to remain high for some time before coming back down. And I guess secondly, it shows the degree of uncertainty in just a 3-month period. You can see how far those curves have shifted. And there's quite a lot of uncertainty, I suppose, about where those will go now. Gas prices actually since the May report have actually come back down. What's fairly certain though is that in October, households will face a very significant increase in their gas and electricity bills, because electricity as well, a large extent of the UK's electricity is generated, is gas fired. And back in May, we were forecasting that households could see a 40% increase in their energy bills in October. That reflects that the energy regulator in the UK allows increases in cap prices twice a year in April and October. So we've already seen the April increase, but it looks very likely that a big increase is coming in October as well. If you could move us on one more, please, Robert. So, a big story during COVID has been bottlenecks and supply chain disruptions, and there's very few companies we speak to who don't say that lead times on their materials and components, as well as, really extended out from sort of a few weeks to a few months quite typically, as well as increasing in prices. What we were seeing, I think, early this year was that those supply chain disruptions seem to be easing back a little. I think in recent weeks there is a sense that those are tightening again, and a large driver of that, not surprisingly, is the Russia-Ukraine situation. Could move us on one more, please, Robert. So just building on that in terms of Russia-Ukraine, you can see on the left-hand side that both Ukraine and Russia, are big sort of basic food commodity producers. On the right-hand side, Russia, particular producer, and I'm sure people have seen in the past that there's been very big increases in food commodity prices and metal prices since Russia invaded Ukraine. So that's an additional pressure, an additional uncertainty that we're battling with. We're also seeing supply chains and some prices increase now because of intensification of COVID restrictions in China, and that feels like it's starting to worsen some of the supply routes there to some extent. If you move us on one more, please, Robert. So moving on to unemployment in the near term, broadly, we think the labour market's going to remain very tight. It's been very difficult to forecast unemployment and employment recently. The labour market's been quite disrupted during COVID, but we do think that unemployment will stay low in the near term, and that partly reflects that although there's a sense amongst businesses that things have got to weaken to some extent, on the whole, business sentiment at the moment is still fairly good. But there are, I would say, more people telling us that they're worried perhaps about looking out into 2023, particularly given the sort of squeeze on household incomes. So that's the sort of immediate feeling for unemployment staying low, labour market staying tight, which will mean wage inflation still. And if you move us on one more, please, Robert, I can say a little bit about what we've seen with pay growth. So this figure is showing sort of pay growth over the last 4 years. During COVID, there was a lot of sort of noise in the data due to compositional effects, particularly furlough. But the orange bar here shows what we think is sort of underlying pay growth. And I think it's worth remembering that when we went into COVID, we had very low unemployment, slightly higher than it is now, but it was very low. And the labour market was very tight in 2019, early 2020, and sort of pay growth was running at 3.5%. What we've got now, though, is pay growth actually running at about 5%, which historically is very, very high. And that, of course, is something that's a worry for many firms, and I'll say more about that later. So if you move us on one more, please, Robert. So look, this is something. This is a survey that the bank's agents did a couple of months ago, and it's a question to firms about their pricing and what's driving increases in pricing. And I think it's worth saying that most firms we spoke to, or most firms we surveyed, felt reasonably confident about raising prices, and I think that's partly because they would sort of tell a story that customers generally could see that there was a lot of inflation around, so that on the whole, on average, they were probably less resistant to price increases that they may have been previously. But the big factors really driving growth in prices was labour costs, raw material costs, energy costs, and transport costs. And some of my contacts, and I'm sure this relates to many of you as well, would just describe it as really a perfect storm of cost increases. And in that sort of environment, firms have got to raise prices in order to sort of maintain some degree of profitability. If you could move us on one more, please, Robert. So this is a survey we did in the last couple of months with the Bank of England agencies, and it's looking at asking firms in different sectors the extent to which they think they're going to raise prices over the next year. And I suppose the big story here is that firms in all sectors expect to raise prices by more in the next 12 months than they did in the last year. And a large chunk of that is actually reported to be in the next 3 months. So that's the orange bars in the sort of second block in each of the sectors. So there is a sense that firms are still looking to increase prices because there's still a lot of cost pressure coming through. At the same time, though, consumer sentiment is starting to weaken, and this is a worry for firms. And if you could move us on one slide, please, Robert. This is the GfK Consumer Confidence Index, and it's broadly showing, so the orange line is showing that that's really dipped down in the last sort of 6 months or so. And that very much reflects the squeeze on household incomes, which is showing on the sort of blue line. So not really surprising, I think, in the sense that we've got a very well documented household income squeeze on the way. Not a big surprise that it's falling back, and firms are starting to say that that's a concern. They're thinking hard about pricing, about employment levels, and about the extent to which they invest as well. If you could move us on one more, please, Robert. So taking that sort of fall in consumers' confidence, we're already starting to see a fall in real terms consumer spending. So it seems broadly that household consumers are keeping their nominal spending the same, but given the large price increases across most goods, that they're clearly, their volume of consumption is lower. It's about the same in actual sort of nominal values. And I think when I've spoken to consumer-facing firms, perhaps in the last 6 to 8 weeks, you start to really get a sense that people are starting to see demand and consumer spending really fall for certain products. I'm thinking things like sort of home furniture and furnishings, so discretionary items. So where people have to spend money on energy and food, they're cutting back on things that perhaps are more discretionary and they don't have to buy right now. If you could move us on one more, please, Robert. So look, I feel like there's a sort of a flurry of bad news here. So I'll throw in the sort of GDP growth figures as well. So this similarly is our projection for GDP growth going out 3 years. Again, if you take the darker shaded area in sort of blue turquoise on the right hand side, and draw a line through the middle of that. That's the central expectation. The shaded areas shows the sort of probability distribution and reflects the uncertainty. But the key message here is that the Bank of England, and again, this isn't just us. If you look at people like the IMF and the OECD and the CBI, the projection for growth for the UK economy, it is very, very low growth or even declining growth. Broadly, I think if you assume we're not going to see very much GDP growth over the next 3 years, that's pretty much the story that's consistent from the bank and from the sort of large forecasting organisations as well. So if you could move us on another one, please, Robert. So perhaps with very low GDP growth, it's not surprising that we expect unemployment will pick up. Clearly, from very low levels now, I mean, unemployment currently is, I think, the lowest it's been since the mid-70s. We do think it will pick up to about 5.5% by the end of the forecast period. I think that may make it easier to retain and recruit people for some firms, but I think, you know, we went into COVID with people telling us there was big structural labour shortages in a lot of sort of roles and skills across the UK, and clearly, you know, those haven't changed. And I think for some firms, even with higher unemployment, it will still remain very difficult to retain and recruit staff. But we do see a pickup in unemployment, fairly moderate, about 5.5%, as I said. So that's the sort of story. So I'm going to move on now. So if you move us on a slide, I'm just going to talk a little bit really to wrap us up for the next sort of 5, 6, 7 minutes or so about some of the key assumptions, and then I'll move on to Q&A. So it is an unusually uncertain time, I think, still in the economy, and there's 4 key judgments that the bank has in terms of its forecast, which clearly, you know, determine that forecast, and we accept there's a lot of uncertainty around. So the first big assumption, I suppose, is that we've assumed that the prices of you know, key commodities and other tradables, including energy, that they stabilise during the next sort of 3 years. And I think this is, you know, this is a really big assumption. If you move us on one, Robert, I can show some of the detail of those. So I appreciate there's a lot in this table, but here we've got the sort of oil prices and gas prices numbers that in the sort of 3rd and 4th row. And this is just showing really the assumptions that are in our forecast. So we're assuming that oil prices and gas prices stay high throughout the forecast period, but they don't, you know, they don't increase more. I should say that this partly gives you some of a reflection of some of the uncertainty at the moment. So the figures in brackets from 2022 underneath the sort of bold figures are actually the figures from the February forecast we had. So if we're looking at gas prices, for example, this May forecast had gas prices staying at, I think it's at 242 pence per therm. But actually back in February, we were at 152 pence was the assumption. So it just shows you the volatility in that market. So forecasting our energy prices at the moment is clearly very difficult. And clearly whatever we have in the forecast is going to have a huge impact on the inflation number that comes out for the forecast. What I should say is that, you know, even if we're assuming that energy prices sort of stay high but stabilize, actually in 12 months time that means that energy isn't contributing at all to inflation, because inflation is a sort of 12-month index. But clearly, you know, there's a lot of uncertainty around where energy prices are going. So that's the sort of first big assumption that I wanted to draw your attention to. If you could move us on one more, please, Robert. So the next big thing, you know, is really what happens in the labour market. The labour market's very tight now. You know, we do think to some extent it will fall back, but there's a lot of uncertainty, I think, about 2 factors. One is the extent to which economic inactivity stays high, and the other is, you know, the extent to which migrant workers want to or are able to return to the UK after COVID, given that, you know, it's sometimes easy to forget, but we've also had Brexit, and that changes some of the rules for people coming to work in the UK temporarily. If you move us on one slide, Robert, I'll say a bit more about the labour market inactivity point, because this is something that I think has been something that's really thrown us to some extent in terms of trying to predict during the last sort of period where we've had COVID, that actually economic inactivity is significantly higher now than it was pre-COVID. So this is people who are, you know, are of working age, but effectively have decided they don't want to be in the labour force, so they're not in employment or they're not looking for employment. And the two groups where we've seen inactivity increase most are younger people. So there's more younger people in full-time education. Now, I think broadly you'd expect that to sort of normalise at some point. But the other area where there's perhaps more uncertainty is that older workers, typically over 50, economic inactivity amongst that group is considerably higher. And there's lots of different theories about why that is. Part of it is well documented that there's been an increase in illness, which is long-term illness, which is related to COVID. But also, I suppose, more anecdotally, that people looking to retire early or reduce their hours and to change work-life balance, perhaps in reaction to what's happened to them during COVID. So a lot of uncertainty, I think, around the labour force, and it's possible that higher level of economic inactivity could be more persistent, could become a permanent feature of sort of life in the UK going forward. If you move us on one, please, Robert. So the last, the third key judgment, is that the squeeze on household incomes leads to a slowing in demand. So this is most likely to be true for lower income households where energy and food is a very high proportion of what they spend. It's inevitable that those people in those households will have less money to spend on other items, and indeed some households may be struggling to buy energy and food, never mind buy other things. And the more uncertain question, I suppose, is what happens to maybe the average household. And if you move us on another slide, please, Robert. A lot will depend, I think, perhaps for the average household or higher income households, about the extent to which people are willing to run down savings. So it's well documented that household savings increased during COVID, typically though amongst wealthier households, and the extent to which households are willing to reduce their sort of target level of savings right now, or indeed to go out and borrow to try and keep consumption the same. Now the forecast does factor in a fall in the savings rate in the near term. To some extent, that means that the slowdown in consumption is less than the slowdown in GDP. But we think there's risks on both sides here. I think a key driver here will be the extent to which unemployment does increase. If unemployment increases more than we think, then that's likely to have a disproportionate effect on consumption, because if households can see that unemployment is rising, they're much more likely to be careful, to be worried about the risk of redundancy and put back spending. If you move us on one more, please, Robert. So this is the last of the sort of key judgments, and this is that we're assuming that domestic price pressures, whilst they may be building still in the next six months, but they fade over time, and that some spare capacity opens up. And as I said before, domestic inflation is very much driven by the labour market. And if you move us on one more, please, Robert, I'll just say a quick word about that. So we do feel here that with the labour market, that there are, if anything, that the risks to the assumptions we have are to the upside. So we're looking here at the Recruitment and Employment Confederation. If you look at that top line, Recruitment and Employment Confederation KPMG survey is showing a really strong pickup in pay growth. Now, by that survey, pay growth could actually get to 6% or even higher, and we've got an assumption of 5% in the model. So we do feel with the labour market that there's an upside risk really to the forecast, and that's something we'll be looking at very, very carefully. We do pick up from a lot of contacts that employers have, and to some extent still are, looking at things like one-off pay bonuses to help people with the cost of living squeeze, and are looking at more frequent changes in pay. So we don't get any sense of the labour market really starting to cool down. So it's a big assumption we have in the model that, it will start to cool down over the next 6 to 9 months. The last slide, if you move us on one, please, Robert, is around policy. So I'm sure many of you have seen that we cut the base rate to 0.1% when COVID sort of first really hit the economy last April. That's a sort of all-time historic low. Since December, the bank has been raising rates. We're back to 1 percentage point now, which is still very low by historical standards. The majority of people on the Monetary Policy Committee, so there's 9 people on the committee, the majority have been consistently voting for a 25 basis points or a 0.25 percentage point increase at the last few meetings. At the last meeting, there were a minority of members. 3 members wanted to increase 50 basis points or 0.5%. I think it's fair to say within the committee that there's a real variation of views about the extent to which rates need to rise and how quickly and by how much they need to rise, and that really reflects, the really high degree of uncertainty in the economy. There is another vote tomorrow. I think the market expectation is that rates will increase by another 25 basis points tomorrow. Now, I think that's probably enough. We've just gone past 1/2. I want to leave 30 minutes for questions, so I'm going to stop there and hand back to Pete to facilitate the questions.
Thanks very much, Paul. As ever, very insightful presentation there. Thank you. I think maybe 1 or 2 people did experience a little bit of sound issue, so apologies if anyone was affected by that. But yes, as Paul says, on to the Q&A. So one of the questions that did come in was just regarding the thoughts around tomorrow's MPC meeting, Paul, which I think you've sort of touched on there really. So probably market expectations for a 1/4% rise. That's the main thinking, is it?
Yeah, that's as I understand it. It's I mentioned earlier that when we did this forecast, the market expectation was that rates would peak at 2.5%. I think in the last couple of weeks, that expectation has now shifted out to 3%. And my best guess is that part of that is very much due that since this forecast, we've had a sort of further fiscal stimulus from the Chancellor with sort of support for households around energy bills and so on. So I think that was announced a couple of weeks ago, wasn't it? So that I presume is what's driving that sort of expectation, market expectation of slightly higher rates going into 2023. But yeah, for sure, the market expectation tomorrow is that the committee will raise rates by a further 25 basis points. That's what I've seen.
Okay, thank you. And again, so sticking around that theme of kind of interest rates, but perhaps encapsulating sort of inflation and the employment market a little bit. I mean, you've touched on some of the sort of views over the next sort of 12 to 18 months. I mean, how far out does the bank typically look to forecast these things, Paul? Is there any views on more the sort of medium term, perhaps into the next 3 to 5 years around some of those factors? Yeah,
we only go out 3 years, Pete, and I suppose that reflects that broadly the sort of view is that if we change interest rates today, that it can take up for 2 years for the full impact on sort of consumer and firm behaviour from that change in interest rates to really come through. So that's the sort of sense of looking at 3 years. We don't try and go beyond 3 years. I think if people are interested in longer term forecasts, it's maybe worth trying. I'm not sure how far out OECD or IMF go for the UK, or indeed the other big forecasting body in the UK is the Office of Budget Responsibility. My feeling is they only go out 3 years. I mean, for the bank, it tends to be, we tend to be looking more at the near-term situation. The Monetary Policy Committee members will always say, they will always say, we don't have a plan for where interest rates are going. We're always looking at the latest data. and the latest, information we have, and we always, we will always be making a decision on that data, because that data can change very quickly, particularly, in the sort of current environment we've had in the last couple of years with such disruption to economies globally.
I mean, obviously, with this sort of inflation that we're experiencing at the moment, there's, as you've touched upon in the presentation, there is some wage growth, so pressure on sort of wage inflation as well. It feels like maybe we're almost trapped in a little bit of a cycle here of price inflation and wage inflation. And how do you think that cycle can be really sort of broken, Paul?
Well, that is the key concern for the Monetary Policy Committee. People talk about wage price spirals. We're very nervous about talking about those, because they take you back to visions of the sort of 1970s, where that was very much we have. I suppose in terms of this forecast and what our current thinking is, households have faced a big increase in the cost of living, really because of a change in the UK terms of trade, because we import most of our consumer goods, and we import, we're an energy importer as well, a net importer, and that's driven an increase in the prices of those goods, and a reduction in household real incomes. Now, the hope, I suppose, is, and what we're assuming in this forecast, is that those prices don't continue to increase to the degree they have in the last couple of years. That means that household real incomes start to rebuild, and in some senses that means that people don't feel the need to look for such large wage increases. We'd also think that unemployment will increase a bit, and that should, you'd expect that would mean that firms are finding it a bit easier to retain and recruit staff, and that would mean reduced wage pressure. But I think a key issue for the UK, and I suppose has been, since I can remember studying economics almost 35 years ago, is that we do, relative to some European countries, a lot of the data shows that we're, a lower skilled economy, that we'd lag behind some of those, our big European and global competitors. And it's clear, I suppose, from government policy that a key driver for spending on education is that we can try and build up the skill base, and that still feels really important. Lots of businesses will reflect that they're trying to sort of do apprenticeship schemes now and so on, and putting more money into an effort into what they do around apprenticeships. So I guess a key aspect for the UK and for our future growth is that we're investing in education as well.
Thanks, Paul. So we've got a couple more questions still to run through, but obviously there's plenty of time left in case anyone would still like to add to the Q&A. So again, there's the Q&A function at the bottom of people's screens if they would like to use that to put forward any further questions. But moving on, so I suppose one thing we've not particularly touched on this morning, Paul, for kind of valid reasons, is just around the sort of housing market. But naturally, everyone always sort of makes linkages between sort of inflation and wage growth and the housing market. What sort of views are there at the moment around house prices? Could we start to see any reduction in house prices, do you think?
Yeah, I can say something about that. I mean, not from the bank's perspective. We do have, and look, we do model the housing market in our economic model in the forecast, but we don't publish the predictions. I think we probably feel that's a bit of a dangerous thing for the Bank of England to do, to say we think this is where the housing market's going. I did have a look yesterday at what some of the big sort of estate agency companies and so on are saying about the housing market. The general consensus seems to be that there's little sign of house price inflation abating right now. So the housing market still seems very strong. I think when we have a lot of business contacts in the housing markets. We speak to people like estate agencies. Certainly, none of them are saying that things are slowing down. But the big forecasters, and you'll know the names, the big sort of estate agency companies, and the big mortgage providers, they are expecting prices to probably stabilise, I think, at some point in the next sort of 12 to 18 months. People will always tell me that confidence is a big driver of the housing market. So, and that unemployment plays a part. So, my best guess would be if unemployment increases to the extent that the bank's thinking, that maybe that's not going to massively dent confidence in the housing market. But if we did see higher unemployment, estate agency contacts would always tell me that's something that can really dent confidence in the housing market. So yeah, I think the consensus view, as far as I can see, is that the market starts to stabilise, but I don't think there's anyone out there that I've seen anyway predicting a sort of crash or a big downturn.
Okay, thanks, Paul. Then slightly changing sort of themes and topics here. Then a sort of question around sort of the government finances. Obviously, recently we've seen some headlines around the cost of sort of borrowing to the government. What are the thoughts around the government sort of borrowing position at the moment, and whether all the sort of QE that we've seen over I guess a number of years now, whether any of that is going to be addressed in the sort of short to medium term?
Okay, I suppose there's two things in there. One is the government debt position. Look, the Bank of England is independent government. We would never comment on how sustainable we thought the government debt position would be. But as you said in the second part of the question, quantitative easing, the Bank of England does hold, I think it's currently around £850 billion worth of UK government bonds. We don't buy those direct, or we haven't bought those directly from the government. We buy them from institutions who've bought them from the government. So we buy them in secondary markets. We've built up a large portfolio. So we got as high as, I think, as £875 billion of government bonds. That's run down a bit because some of those have matured and we haven't reinvested. So we're allowing a sort of natural attrition of that sort of those government bonds. And I think we'll continue to do so. So there will be an update in August about what the bank's position is around sort of the unwind of quantitative easing. So people often refer to it as quantitative tightening, but broadly at the moment, if our sort of bond portfolio, if there's a maturity of bonds, we're not going back into the market to replenish them. So there is a sort of natural rundown of that stock of bonds. But I think there'll be more from the bank on that in August. I think at the last, if I remember right, the last Monetary Policy Committee, the committee has commissioned some work within the bank to think about how we might unwind the government bond portfolio, whether that would just be sort of natural attrition through things maturing, or whether we would actually actively go out into the market and sell some of those bonds. So I think it's a bit watch that space on sort of quantitative easing unwind.
Okay, thanks, Paul. So a couple of sort of questions that have or points really that have come through, and I'm going to put a slight interpretation on them. Is around, obviously in the UK we're very reliant on imports, both in terms of energy and food items. Clearly we're in a as ever a sort of very global sort of marketplace. A lot of the inflationary pressures that we're seeing at the moment are because of the prices of those imports. How much do you feel then actually sort of altering, amending domestic borrowing rates, so the Bank of England base rate, will actually have an impact on those items that really aren't a domestic pricing function?
Thanks, Pete. I think that observation is absolutely correct, that it doesn't have a direct impact. The Bank of England can raise its base rate, but it's not going to impact on global energy markets, and it's not going to impact on global goods prices to any very significant degree. What increasing the interest rate does do is it reduces domestic demand, and that pulls through into some extent into lower inflation. Our sense is that it's not really the increase in interest rates that's in the forecast that's driving our forecast reduction in inflation. It's very much the squeeze on household incomes and consumption. That's what's driving, the lower inflation forecast as we go further out. So I think there's recognition at the bank that there's a lot of external factors that interest rates don't have a direct impact. We would be in a very different environment in terms of, I think, the level of the interest rate and where the Bank of England was if we had 9-10% inflation and that was domestically driven. We would be in a very different environment. I'm sure we wouldn't have interest rates at 1% with a market expectation of 3%. We'd have a much higher expectation. So I think that it's a very good point, and very much a point that's recognised within the policymakers at the bank.
Thanks, Paul. One more that's just come through, and obviously in your role you get to interact with a lot of businesses across a broad spectrum of industries, but through any of the dialogue that you've been having with industry, Paul, are you starting to see any sort of movement towards sort of reshoring, but particularly around sort of manufacturing?
That's a really, really interesting question, and I think to summarise, what a lot of people, I think, would like to reshore. So we have seen some, and it's not always reshoring to the UK. It might be bringing production closer to home. So people will say, we've found some fantastic suppliers in Turkey, and actually, so we're doing less from China now. I think my sense is, though, that a lot of people will say, changing suppliers is difficult. There is a lot of supply that comes in from places like China and the Far East. People have very good, reliable suppliers in those countries, and it's hard to change. And I think what I do hear sometimes is that even people saying, "Well, we'd like to do some reshoring," is that because the manufacturing sector over a long period in the UK and indeed in the whole of Europe has got smaller, it's sometimes hard to find firms who can provide what you need at fairly quick turnaround in the UK or Europe. So if I hear about people changing supplier, it's more often that they're looking perhaps to countries outside China typically, and people talk about India quite often, or they'll talk about sort of maybe Vietnam or Indonesia. So I think that probably reflects that the Chinese government's been very tough on COVID and some of the COVID restrictions, and maybe a sense that they want to try and have a more diverse supply mix. But yeah, so it's a very long-winded response to the question, but it's a very complex question, I think, and it's very different for different manufacturers. But there's certainly an appetite amongst people, because I think if COVID has shown one thing, it's that supply chains are very complex, and when you have a major global shock, they can be quite, well, I was going to say fragile, but they can be a little bit fragile, but also in some ways remarkably resilient, I think, given the extent of the shock that stuff has still been getting through, albeit with some well documented difficulties. But yeah, I think there's definitely opportunities for UK manufacturers who, smaller manufacturers looking to supply into OEMs and so on. There's definitely opportunities there, and there is an appetite to reshore, I think, where people can. But I think that my general sense is that it's difficult to do.
Excellent. Well, thank you very much for all those responses, Paul. I think we've sort of worked our way through the open question bank there, so we might be a little bit ahead of time, but I think that probably wraps us up for today. So once again, thank you to Paul as our guest speaker. I hope everyone has found it a useful session this morning, and look forward to seeing you all again very soon. Okay, thanks everyone.